Hello and welcome to Earnings Echo. We put together the most important information about Shift4 Payments, Inc. Uh, Today we are diving into their Q1 print, and, well, you immediately hit a pretty glaring contradiction right off the bat. On paper, they reported a GAAP loss of a penny per share, but operationally, they seem to be firing on all cylinders.
Yeah, the key here is cutting through that accounting noise. That 1 cent loss is heavily distorted by acquisition amortization.
Right, because of deals like Global Blue or Vectron.
Exactly. Accounting rules force them to deduct the value of those brands over time, so it looks like a loss, but no actual cash is leaving the bank. To see the real cash generation, you have to focus on the adjusted metrics.
Which are massive, honestly. Q1 gross revenue hit $1.12 billion, up 32% year over year.
And their core profitability metric, gross revenue less network fees, or GRLNF, surged 49% to $549 million. That hit guidance perfectly.
So, if you are trying to gauge actual performance, you should focus on their estimated fiscal 2026 non-GAAP net income, which project out to about $510 million.
Right, and management confidently maintained their full-year guidance, projecting 26 to 31% GRLNF growth.
But let me challenge that optimism for a second. We know the U.S. restaurant sector is soft right now. Small to medium businesses are seeing flat same-store sales. So if restaurants aren't selling more food, how exactly is Shift4's America segment keeping up?
By aggressively taking market share. Even with that macro headwind, America's revenue grew 15%.
Because they aren't relying on restaurants selling more burgers, they're just bringing more restaurants onto the platform.
Yes. Active merchants using their SkyTab POS system, which is rebranding to Shift4 Dine, jumped over 40% year over year. More than half of their active restaurant merchants using software are now on that specific platform.
Well, if the U.S. market is just churning out steady growth despite headwinds, where is that massive 49% overall momentum actually coming from?
That leads us straight overseas. Worldwide payments revenue skyrocketed 51% year over year.
And that international explosion comes down to their unified Shift4 One product, right? Combining payments, dynamic currency conversion, and tax-free shopping into a single device.
Correct. It is live in 7 countries now, and they are targeting 15 by year-end.
Although, that tax-free shopping piece is a bit of a double-edged sword. On the earnings call, management was surprisingly blunt about geopolitical risks.
Yeah, they didn't sugarcoat it at all. Travel disruptions from the Middle East conflict are severely choking off the highly profitable travel corridor from the Gulf region into Europe.
Management explicitly quantified a $4 to $6 million hit to Q1 revenue directly from those travel constraints.
And they preemptively baked a massive $20 million disruption impact into their Q2 guidance.
Yet, despite embedding those heavy headwinds, management is aggressively bullish with their cash. They bought back 5.5 million shares for roughly $297 million this quarter.
Which brings us to the most fascinating part of this deep dive, the valuation. Let's run a reverse DCF model.
Right, a reverse discounted cash flow. Basically working backward to see what future growth rate the current stock price implies. So right now, Shift4 has a $4.2 billion market cap. Using that $510 million non-GAAP net income, the market is pricing in a negative 6% annual growth rate over the next 10 years.
Think about what that actually means. The market is effectively betting that Shift4's net income will shrink from $510 million to $275 million over a decade.
It's absurd. Since 2019, they have compounded their core revenue metric at 5% annually. Valuing them at negative 6% growth is like betting a sprinter who is currently breaking world records is suddenly going to start running backward.
Even if we zero out their growth completely, fair value spits out at $6.5 billion.
Meaning the stock is 55% undervalued just to reach a zero growth scenario. So why is Wall Street so pessimistic?
It is a perfect storm of anxieties. First, Shift4 carries a 3.7x net leverage ratio. Institutions look at that debt load in an unpredictable interest rate environment and get incredibly nervous.
And combine that debt with the geopolitical impacts on European travel and broader fears of a consumer spending slowdown.
Exactly. The market simply compresses the multiple and punishes the stock.
So what you really need to take away from this is the sheer scale of the dislocation. There is a massive gap between Shift4's 49% operational growth and a market price forecasting 10 years of decay.
The long-term bet here relies on international expansion overpowering these temporary macro fears. And here's something else for you to mull over.
What's that?
If Shift4 hits that 15-country target by year-end, proving out their global model, while their stock remains priced for a recession, Well, they become a prime acquisition target. Who might be looking to scoop them up at a 55% discount? Something to keep a close eye on.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked. Portfolio prepped. Catch you again soon.